Good afternoon, everyone, and welcome to TradeStation. My name is Michael Burke, and I'm Vice President of Client Training here at TradeStation, and I want to welcome you to our options trading series. Tonight, again, we have Price Headley, who will talk about how he trades weekly options. It's always great to have Price here. He's just an outstanding market analyst and one of the true experts in the options world. So it's always great to have Price here. Please keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed are for instructional purposes and not recommendations. Active trading is not suitable for everyone. Options trading, doubly so. Please read all the disclosure information in the PDF handout that I'm going to push into the chat, along with the options disclosure documents that are available on the TradeStation website. So Price, it's always great to have you here. It's all yours.
Well, thank you, Michael, and welcome everybody. So glad to be with you here, and always excited to talk about weekly options. They've become really my favorite options trading vehicle. Of course, as you know, with options, you tell me what you're looking for a strategy, what you're looking for a market outlook, and it's easy to set up the right option strategy. Of course, weekly options give us that much more flexibility because now you have options that are literally out there for every Friday becoming an expiration Friday. So we're going to talk about that today, and of course spend some time in the TradeStation platform to walk you through some of the indicator setups I look for finding trends in the short term, and also walking through Option Station and Radar Screen, a couple of my favorite tools to really help you sort out which strategies you might be wanting to consider. Now remember, everything that I share with you today is geared for your information and education only. Even though I'm going to be looking at live markets, please just remember that nothing that I talk about here should be considered a buy or sell recommendation on any particular security. And ultimately, remember that you are solely responsible for your investment decisions. Here at Big Trends, we seek to be a resource for traders to hopefully make better decisions in the heat of battle, and ultimately you need to make sure you are consulting with your financial advisor and tax advisor on anything that might affect your unique financial or tax situation. Okay, with that out of the way, what we're going to focus on is what weeklies are all about. You know, weekly options really came into prominence several years ago, and for a long time I was lobbying the exchanges, as I'm sure others were, say, hey, I don't want to have to buy even a month's worth of time if I'm only going to be in and out of the trade in a week or so. And so we're going to talk about that, especially how you can trade some of the high dollar stocks with weeklies, because let's face it, it costs a heck of a lot of money if you're trading Apple or Google or Priceline, and you would like to, you know, maybe get some extra bang for your buck, or at least not tie up so much capital in trading each 100 shares, or at least getting a good amount of control on that 100 shares with an in-the-money weekly option. We're going to look at a variety of chart examples, focusing on what I call a multiple time frame analysis, the triple time frame as I call it, looking at the daily chart for the bigger picture, but then looking at hourly charts if you're more of a swing trader, and even 15-minute charts for you day trader to quick trader types out there. Out of curiosity, just to get you engaged here, I am curious, what would you classify yourself as in terms of the type of a trader that you like to be? Is it more of a day trader, in and out in the same day? Is it more swing trading, which I tend to define as 3 to 5 trading days, but it could be even shorter? And then some of you that are more position trading out 1 to 4 weeks, looking at the daily chart in that case. So we got some swing trades to kick us off. An options newbie. Don't worry, Elizabeth. We'll keep it really simple here today and focus on some of the really effective ways that you don't have to get too complicated in your option strategies. Swing to position on a few folks, and the occasional day trader in there as well. So what we talk about will apply. It'll just be a matter of the time frame that you want to focus on will be where you want to then decide, okay, if you're more of a swing trader, I say focus on the hourly charts. If you're more position trade oriented out over the next several weeks, I'd say look a little bit heavier at the daily charts. Doesn't mean you can't also look at the other time frames, but we'll look at all of them together. Now, when we talk about weekly options here, and you can see we actually have a nice calendar that does a good job of showing us where we are this month and saying, it used to be in the olden days that I've been trading for options for about 25 years now. I got started pretty fresh out of Duke University back in 1990 trading, and unfortunately maybe thought I knew it all a little too fast. I think you all are doing the right thing here to get yourself properly educated. And I truly believe in the power of TradeStation. I've been using it and its original technology since back in the early 90s, back when it was much more just programming code, even as they were launching out easy language, and basically just a huge fan of the ability to go codify any idea that we have. Well, the bottom line is, back to the weekly options, saying, okay, we want to say, let's make sure that we have a systematic approach to trading them. When I first got started trading, I was definitely flying by the seat of my pants on my own trades before starting big trends, and bottom line is learned some very powerful lessons about the importance of having a more systematic approach. And so we're going to look at the systems that I've developed here for weeklies, really focused on being in and out over about a week or less. Okay, so these options used to be in the olden days that the monthly options would just expire after the third Friday of the month. And so you can see on the traditional monthly options here, we just had the monthly expiration here that just ended here this past week, effective Saturday the 17th. So you'll see on the monthly options that I used to just do this strategy in the final week of those monthly options lives, but now we actually have every single Thursday a new weekly being introduced on a variety of different contracts to expire the following Friday. And some of the most active names like Apple or Google, you'll even have weeklies going out typically about 4, sometimes more expirations. And then you'll notice, like we just listed today, on a variety of weeklies to actually then expire next Friday the 30th. So you just had a whole new batch of weeklies come in, as well as, of course, last Thursday a batch that came in for the 23rd that expires now tomorrow. And then they don't list any on that 8th to expire on that Friday the 16th, because you already have the monthlies in place, so those monthlies start trading like weeklies in that final 7 days of that monthly options life. So we'll use those monthlies in that particular week as our weekly type of a substitute strategy. Now, we're going to keep it simple and say, how can we find some opportunities to go take some of these higher dollar stocks and actually try to take advantage of some of the moves that they may present to the upside or the downside, while still keeping it fairly simple. And so, of course, that earnings are a huge driver of stock prices. However, I don't tend to advocate that you try to rush into those plays in front of earnings, because you're going to pay through the nose for that privilege. Because the market makers know, just like you and I know, what the next earnings date is for any given stock. We've still been having some earnings trickle in this week from names like Home Depot and Salesforce.com, and I believe Hewlett-Packard was due to report after the close, and yes, they just reported, and they're getting knocked back down a little bit here after hours. So bottom line is that we want to be aware of that, but at the same time try to get a sense. Walmart's another one last week. That's right, Elizabeth. That I would generally try to trade those after the news hits. So my view is, you think, well, hold on, hasn't the move happened after the earnings hit? Not in my experience. A lot of times we'll look at Apple or other names that we've been in where, you get some continuation move where the institutions want to typically pile into good news earnings situations and potentially pile out of the bad news earnings disappointment type of situations. Now, it's not just individual stocks that have weeklies. You also have the big indexes and ETFs that also have weekly options as well. So, when we start to say, okay, what kind of names can we trade? I mean, the list keeps just going bigger and bigger all the time. But, when it comes to individual stocks, we'll put a lot of energy into the big names like Apple or Google. We've done Priceline, we've done Chipotle, we've done, just a lot of different stocks. They don't have to be tech stocks, though. You see names like Caterpillar on here. Of course, the gold market, GLD, can be very active. The problem with gold has become it's been a little bit gappy, where you'll get quite a few gaps overnight. And we want to try to minimize that. If you're going to carry positions overnight, for a lot of you swing or position traders, you want to try to minimize your gap risk. The S&P Spiders, the SPY ETF that trades about 1/10 the value of the S&P 500 index, is one of our favorites as well, because you get such great liquidity. When we go in and look at the options here in a minute, you'll see just how nice and tight those bid-ask spreads are. So you can get in and get out trading against a lot of other traders, not just you against the market maker. So that's important. So we're going to look at that here in just a minute. Now, one of the things that I think is an eye-opener for folks, and then I want to show you some charts here straight out of TradeStation, is that you look at these different underlying stocks or ETFs or market analysis, and then you try to figure out, do I buy an option here? Do I sell an option? Do we, how do we, configure our option strategy relative to our expectations about what the stock may do? And I asked the question more than a decade ago and said, what would happen if you also looked at an option chart? And frankly, TradeStation has been at the forefront of keeping option charts out there, not just while the option is trading. We're talking about the price chart of the option itself. So the open, high, low, close of the option today, tomorrow, or every 15 or 60 minutes for your active options. If they're not active, by the way, I wouldn't consider this to be as relevant. So I really would say focus on your big name optionable stocks that have a lot of options activity to make that option chart valid. But is that chart, do you think, different than a stock chart? I've even had this debate with well-known options strategists who tell me that, why am I even bothering with this, because an option is just a derivative of the stock. And I say, it is a derivative of the stock, but the underlying stock price is not the only input in the options pricing model. You know that an option is a time-limited asset. You know that an option is priced based on the volatility of the underlying. The more volatile that stock or market, the more those premiums go up, all other things being equal, right? So, and even so for you options newbies, the bottom line is that these factors that go into the options pricing model will make the option chart look quite different than the stock chart. For example, that if you had a stock that was just staying flat here, and you bought the at-the-money option, let's just say we did a classic profit and loss diagram, and say that you've got your stock basically over time just going at a basic flat line. It's not making any progress. And say that you've got the stock trading at, say, $50. Well, you know what? Guess what's going to happen to the, let's just change our color here. What's going to happen, do you think, to an option if you buy a 50 strike call here and nothing happens over time to that stock? What do you think is going to happen gradually to that 50 calls? You get closer and closer to the expiration. It's going to start falling off the cliff, right? So the idea is that, if the stock doesn't move in blue, your call option, or your put option in this case, if the stock's dead flat, is going to be eroding. This is what tends to gravitate a lot of traders towards thinking, well, therefore I should sell options, right? Because decay is always going to be a factor. That's one strategy that you can implement, especially if it comes to out of the money or even sometimes near the money options. But I do like to buy in the money options. In the money options, for example, if the stock was at 50 and we bought the 45 call and we paid $5.50 for it, well, we might have an option that's already worth $5. A 45 call gives you a right to buy it at 45. Stock's already at 50. If it doesn't move, we only lose 50 cents out of that $5.50, or less than 10% of the option premium. That changes the equation quite dynamically. Now, Elizabeth says, when I say lose, do I mean expire worthless? If you buy an at-the-money option, a 50 strike call when the stock's at 50, yes. If it doesn't move at all, stay stuck at 50, you're going to be risking your entire option premium getting eroded due to what we call time decay. But if you buy the 45 call and you pay $5.50 and it's worth $5 intrinsically, if it doesn't move, you're only risking that final 50 cents of the $5.50 as the time value, or some people call it extrinsic value. But I like the concept time value because it's sort of saying, look, you can buy an option that has a very healthy intrinsic value, and then you don't have to pay a lot of extra time value, and then I measure the percentage of those. Generally speaking, first rule of thumb to take home today, in my opinion, is if I'm going to buy a weekly option, it's only got 7 trading days left, I don't want to pay more than about 1/3 of the total premium as time. So it's a pretty good guideline here as we look at our options here. So let's go ahead and actually, let's look at some charts and also look at some components of the options and how we're structured here. So let me go ahead and share my TradeStation desktop here. One moment. And just pulling up the S&P chart. Now we're going to simplify some things here. I've got a lot of different things I look at, but frankly, I want to try to break it down to you to just maybe a couple of key components that you can focus on for starters. And so what do we have on this chart? Well, let's actually start with probably the easiest one that you could visualize here, the 15-minute chart for you quick traders. Looking at percent R. This is the Larry Williams indicator. I know Larry's been on other various trade stations, spotlights and things, and he's really very innovative. I take ideas from wherever, that I think they make sense, especially from reputable traders like Larry Williams, but more importantly, saying also from data that tells me that I have an edge when I test it in TradeStation. A lot of great ideas that you might hear, you can basically put them to work in TradeStation and say, do these things actually work over time? Obviously, the future results are not guaranteed based on past performance. You know that there's always going to be risk that the future is going to be looking different than the past. But the idea from technical analysis is we're looking for patterns that we think can repeat over time. And this has been a pattern that I've found that I've really felt very comfortable following along with. If you're a trend follower like I am, sometimes a lot of you are trying to find the exact turning points in the market. I think that that's kind of a sucker's game. I think that basically a lot of times if you buy low, you can end up, if you're buying a really damaged market, you can end up like the 2008 financial crisis, not catching the bottom right and end up seeing it go down quite a lot more after you buy. So we want to instead look for the right structure of the chart. And so here's my rule for the percent R, just to get you started with something you can take home today. And then we'll talk about some of the extra filters we use to back up the quality of that percent R signal. So the percent R rules, the big trends way, say when percent R goes overbought. Remember, percent R stands for percent range. So what it's saying is that this close, looking back against the last 30 periods in time on a 15-minute chart, that's just over a full day's worth of action. So if you look at the close here yesterday on the S&P, when we were just about to get this buy signal here, the close that was just going back above the 80th percentile. I use a positive scale from 0 to plus 100%. Mr. Williams uses a scale from 0 down to minus 100. But I just find the 0 to plus 100, I call it the grade school scale, something we can all identify with. You're looking for at least B stocks and preferably A or A plus stocks. You want them to be making new highs. And the definition of a trading range, of course, is you're looking back at the recent high that this stock made up here, or the S&P made at about just under 189, and the recent low it made down here at about 187. So that's about a 2-point range, just a shade under a 2-point range. So what that means is that, when you're just under 189 and then we're getting this new overbought signal at about the 80th percentile, technically 80.75%, that's 188.58, just about 40 cents under that 2-point range peak number. So the bottom line is that makes sense. A 2-point range, 20% off of that peak would be about 40 cents, right? So that's where we are. Relative to that high, we're in the 80.75 percentile. I look for trades where we're crossing into the top 20% of potential readings, believe it or not, and then they actually follow through and they keep on going. These are the unusual overbought trends potentially. Not every trade works, but we're going to talk about how you get out when it's not working. The first stop would be whatever that first setup bar, as I call it, whenever that first upside cross happens and you see that low was 188.40. If we get a buy signal here as it breaks above that first high and then it closes back under 188.40, forget about it. I'm done. Bye-bye, out of the trade, okay? So as we zoom this in a little bit, you can see here that yesterday, and we'll talk about what happened today as well, yesterday it started to rally a little bit, and then you got a little pullback. There was some news from the Fed talking about their outlook for the market here. And so, from this perspective, we're looking at a situation here in which, okay, that little one candle down is what we call a retest on percent R, the big trend's way. It means that it looks like it's coming out of the overbought mode now that we've been trending above there, and this is one of the reasons I really like percent R even better than a stochastic or an RSI, because it will give us a little bit more jaggedness to the nature of the trend to see when we get little pullbacks, as I call them, retests, and that's where I would reset my stop. If it closes under that particular candle's low, then it's going to violate this retest, 188.49. By the way, how many times have you missed the start of an uptrend and you say, oh, well, I can't buy it now that it started to run up, but then you don't get back on board because you think you've already missed out? In this case, of course, it did come back to about the buy area, but there's a lot of times where the retest will be happening at a little bit of a higher level. Well, interestingly enough, that little hand-wringing about the Fed comments there didn't last, and then the market held and took off. So the bulls are in control. The thing is, the bulls have the ball. The bears are trying to take it away from them, but this is a key test of the bulls' resolve. Now, we look at other tools like the DMI lines. These are the positive DMI above in blue above the negative DMI in red. The green is the ADX trend. We also look at the commodity channel index, the CCI, which was telling us that soon after that retest, we were getting an even stronger confirmed trend with CCI breaking out above its overbought threshold as well. But we're going to focus today on percent R, keep it really simple. Now, you can notice what happened late in the session today actually is that in the last two 15-minute bars, we had a break under the 80% line at 189.70, and it did close below there at 189.60. So this is officially an exit at the close, or based on the system being true to real-world signals, it's going to actually sell at the next bar's open. So it's going to sell at tomorrow morning's open in this case. Obviously, if you saw it breaking down, we watch these things very closely, we would say hop out at the close or minutes within the close, seeing that it's going to break that prior key retest 189.70 at the close, 189.60. So, we're done with that signal. So you can see compared to the original entry, it was good for about 90 cents on the S&P, about 9/10 of a point. Now, if you were converting that into an option strategy, we're talking about option charts, typically speaking, one of the first things I would say is take a peek at option station. Okay, so if we're looking at option station here and we're saying, okay, option station is just a really nice tool offered by TradeStation. We're saying, you know what, we'd like to go look at, let's just kind of make it a little bigger here so you can see it on the chart, and we're saying, look, if we were looking, we were about 188.70 when we were getting that buy signal, about a point less than where we are now. You can see at the end of the day, if we're looking at the options, these options are going to expire tomorrow. We might not be recommending you trade it quite that close to the vest. I might say, you know what, I'd rather you look at these May 30th weeklies that expire next Friday. You can see those are based on 100 shares. The other ones that say based on 10 shares are called mini weeklies. So those are, were announced to potentially attract smaller dollar players. But, I really like to focus on the liquidity that's available in the 100 share increments. So if we looked at, say, next week's options, for example, well, first rule of thumb, like I said, is, if I was looking right now at it, obviously we're done with that signal, but just for example, 189.5, and remember what we were saying as a basic rule of thumb is, if you were buying the 188 call here at the close for $2.09, well then you'd be saying, well look, that 188's worth about what? $1.60 intrinsically. So if I'm paying, call it 210 for a round number, I'm paying 50 cents over and above that $1.60 as time. You do 50 cents out of your 209 and you say, you know what, that's not a bad ratio. That's basically about 25% time value and about 75% thus intrinsic value. You could get more intrinsic value as you go more in the money. You see that the 187 is sitting there just under $3 and it's about 260 in the money. So you're paying in that case just about maybe 10% more. So that's about 90% intrinsic, about 10% time. So, that's, a starting point. You can see the volatility in these options is very low. It's 10% implied volatility. That's historically very low, and it ties it back in with tools like the volatility index, or VIX, which is sitting at fairly historically low levels as we speak. So the thinking here is, okay, well, if I'm bullish, I want to be trading. And so, I'd probably say, given that it happened about a point lower, we'd be looking at other metrics here like the delta. Another good rule of thumb is, delta, say at 80%, 82 in this case, would imply that if the S&P goes up another point from here, this option should go up 82.6 cents on the dollar, 82% of that point in the S&P. So you would add 82 more cents to that just under $3 vehicle and see that you've got the potential on a 1-point move in the S&P for that option to go up in the neighborhood of almost, 30%, maybe 25, 26%. So, bottom line is, that's another way you can kind of calculate what kind of bang for your buck you're going to get. And generally speaking, for the roughly at-the-money options, you can see 189.50. We now have half-point strikes on these S&P weeklies. Right near the money, that's going to have a delta near 50%, 52% at today's close. A lot of times people say delta can also be thought of as the odds of that option finishing in the money. You can see it finished about 10 cents above there, 189.60, and saying come, next Friday, what are the odds we're going to finish above 189.5? It's saying just a hair over 50%, given that we're already 10 cents above the strike. If you flip that around, given that that's at 52%, I would expect this one to be at 48%. It's, you see it's a minus number on the put side, minus 47.96. So those two deltas, when you factor out the negative sign, which of course is just factoring that you've got an inverse relationship when the market drops, the put option goes up. It's just saying those two deltas should add up to be effectively at 100%. So 52% plus 48%, yep. Pretty fair and fairly priced markets when you look at it that way. You can see each one of these 60% on the delta on the call for the 189 and the put delta 189, 40%, give or take a fraction of a percent. So, interesting little tidbits there. Now, buying the option is usually the first place that I look because I want to find a trend move. For some of my workshop students that I do a weekly workshop trading room, we'll do also then maybe selling another option against that. So you can start modeling, for example, the debit spread, saying, you know what, if I went and I looked at the S&P chart, let's go for a second and take a peek at just the bigger picture S&P chart. You say, yeah, you're bullish here, Price, but look at all that resistance is up here just overhead at around 190 or less. And so you say, you know what, yes, we're bullish here, but, and notice the hourly chart I think is still bullish, so even though the 15-minute gave it up a little bit late, saying, yeah, I'm still a little bit net bullish, but I'm a little worried about that 15-minute rolling over. So I'm going to sell the 190 call against maybe my 188 call, for example. So in this case, we're saying, look, if we were buying the 188 call here, we said call it 210 for a round number, and then you're selling the 190 call, and again, we'll call it 70 cents for a round number. You get a little bit more than that, 73 cents bid at the close. What you're doing when you sell the 190 call is you're saying, well, I'll give up my upside above 190, but really you're saying my effective point where I'm wishing I hadn't sold a 190 call is the strike price I sold of 190 plus the premium I collected here of 73 cents. So over 190.73 next week, and then you're going to kind of say, gee, I wish I hadn't sold that option. If it closes at 190.25, I still pocketed about almost 3/4 of a point, so I'm still ahead of the game by effectively an extra half point over and above that 190.25 level if it finishes there. So the point of a debit spread is it lowers your cost from 210 down here to say minus 70 plus cents, call it $1.40. You see officially it's like it's actually more like $1.36, right? So you're saying, look, if it's at $1.36, pay the ask and then sell the bid. You're saying $1.36 with the potential from 188 to 190. If it finishes above 190 next week, that spread's going to be worth $2 at the expiration next Friday, the 30th. Remember, these are May 30th expirations over here. Okay. So from that perspective, you say, okay, hold on. So $1.36 could turn into $2. Well, that's interesting. So you say the nice thing about it is that $2.10 I would have had to have paid here, I've lowered my effective cost down to 36. Well, so I've lowered my cost by about a third, right? And you say, so what's the trade-off of that? Well, the trade-off is I've capped my upside effectively at the strike price I sold plus the premium I collected. So as I said, 190 plus the 73 cents over 190.73. I'm going to wish I'd probably just bought the 188 call. Well, we can manage our way around that when you go in and you look at, say you're looking at the hourly chart as a swing trader for where's the market going next. And it's been a pretty choppy market. You can see if we don't have a continuation move happening, the percent R will tell us the percent retest is violating. We've got to hop out right there, right before it dropped off more significantly. Same thing on the prior couple of signals. It just wasn't quite giving us the lift that we wanted here in May. Now, even though the market is hanging a lot tougher in May than probably most people would have expected, right? The old sell in May and go away theory, we started the month off 188.38 and we're up more than a point despite all the May and beyond fears, right? Sometimes that wall of worry is a very good thing. But you can see you can catch some nice little windows here where it can evolve, and then when it does end, it'll tell you, okay, well, that last retest violated, in that case on a gap down the next morning, and you say bye-bye. You still made a little bit of money. But that's where the debit spread can stabilize your returns. So that's one approach you can use. Let's go back for a second to taking a peek here also at a couple other things I want to mention on our slides, and then we'll come back and look at a few more examples on the charts here. Now, you know, we talked a little bit about delta. That's how much the option should change for a $1 move in your favor in the stock. So, you know, from this perspective, we're saying, you know, pretty choppy. Understatement. Pam says, yeah, and there's no doubt it's been a less than trending environment. So, you know, that's where as we go into individual stocks, we'll look at Apple and some of those in a minute, where you can have a better chance to find meaningful trends in the individual components rather than when 500 components in the S&P are counterbalancing each other and creating a lot of whipsaws. So whipsaws are not our friend, obviously, as trend traders. So we're looking, as we said, usually at least about a 70 delta up to about an 80 delta for weekly option purchases. Now, theta is how much that option is going to decay per day, all other factors being equal. You know, so when you look at your option station chart and you see that it says, well, our theta over here is on the 190 call we're selling is minus 0.0576. So it's saying you're going to lose about 5.7 cents every day, all other factors being equal. So if this thing never moved, volatility never changed, all the other inputs don't change except time is going by at a very predictable rate, right? We all only have 24 hours a day. The markets know, okay, this option only has life to next Friday. So based on that, it can say, okay, all other factors being equal, that 75 cents is going to bleed out at a rate of just under 6 cents a day, looking out over the next roughly week and a day. Okay, and that's just the time portion. Now, when we go back here to the slides, you know, we would also, you know, keep an eye on Vega mildly, not a lot. Vega is just how much volatility changes one factor. The big Vega change that happens is when you come out of the pre-earnings and you actually have the earnings report, and you'll see a lot of times where volatility, the Vega V for volatility, remember that you can see that you'll see collapses in volatility and a big change based on the Vega shrinking down after the earnings. Then gamma is another little more aggressive term for those that like to trade options that might be picking up delta faster. Gamma, we'll show you a chart of that, will actually rise the fastest for at-the-money options, or even slightly out-of-the-money options going to in the money. You can see probably the most visually representative chart is the one on the right here. You can see if we were down to the final day of expiration here in red, and you say, well, look, if you're right at the 50 strike price, and it says, look, if you buy the 50 call, and you're right about the 1 point move, it's saying that, look, think of gamma as what your delta is going to be after the 1 point move for the next 1 point. So typically our deltas on an at-the-money option with a day to go before expiration, it's like a coin flip. Are we going to finish above or below 50, right at the 50 level? You could literally flip a coin. So you're going to see about a 50 delta to start out. And then it's saying that, look, it's got about a peak out here at about 43%, 43 gamma. That means that on a 1-point move up to 51, when it hits 51, it's saying that your delta will be at 93, 50 plus the 43 gamma will make 51 now a delta that will be up there at 93 from 51 to 52. So it's moving almost point for point with the stock in that final day of the option's life. It cuts both ways, of course. You can see that as it drops, you drop down here to 49, you're going to be looking at a 1 point out of the money option with a day to go, going to be dropping down to somewhere in the neighborhood of about a delta of just under 10. Okay, so that's going to have a very low probability of finishing back in the money, about a 10% chance of finishing back in the money in the final day. Okay, so that, and then you can see here that this is the in the money example. If we look, I'm sorry, at the money example there on the blue line there, ATM. Okay, so ATM at the money example there, when you're saying, okay, hey, that has a ton of gamma as you get real close to the expiration. Look at what's happening to the gamma. It's going up, up, and up. That just means that, yes, there's a lot of potential changes. So you have to be aware of that gamma risk some people will talk about when you're looking at, say, selling an option with a day or two to go before expiration and saying, wow, it looks like there's a lot of premium there. Well, that's because even some small moves could create some meaningful flips in value. So just be aware of that. Now, you know, with our weekly options program, we call it Weekly Options Accelerator, we're looking at a variety of different pieces of the puzzle. Obviously, we'd like to pick up deltas via, you know, reasonably good gamma boosting as we go from it's been at the money and starting to move into the money. We look at %R plus other tools like CCI to back up what we're seeing. I'll share a little CCI overview. And we look at just over 100 stocks now. We're always adding to the list of anything that gives us some potential bang for our buck. So one of the things I want to look at here is, for example, look at Apple. And you know, Apple's been a perfect example to me of, you know, what I like to see coming out of a news-driven event like earnings. Okay, so we're going to just look for a second at, we'll look at each of the time frames here. Let's just start with the daily chart. And so here's Apple's daily chart. Now you saw a gap up after the earnings this past month. And there's the gap right there. It went from like 525 up to 570 on that high. Now we don't buy there. %R is just crossing that overbought threshold. It's gapping up to, you know, new recent highs, new high, the highest levels it's been over the last 30 days. Well, the point here is that, okay, that high was 570 on the nose. And you can see my rule is it's got to close over that high to tell me that we're ready to get some follow-through continuation trend. So it did the next day's close, the 25th of April. It closed at 571.94 after being down a good chunk of the day. It rallied and surged into the close and finished above that. So that's the official confirmation point of a new big trends %R buy signal. Now you see we're getting it effectively at the next bar's open, because I assume if you're not picking these up during live monitoring, you might run a nightly scan and then you could buy at the next bar's open. And then it absolutely surges from just under 573 to 595 that one day. Now that's not necessarily the pattern you're always going to see. I don't expect it to get that big of a gain that quickly necessarily. But we say, look, you know, and we mentioned CCI. CCI is the same concept, the Commodity Channel Index in yellow here. These are tools that are available in your trade station. You just have to tweak them a little bit. I use a 60-bar CCI, and I say, look, that's the same principle. We crossed up over that overbought threshold there, and then it followed through. So it was backing up %R. ADX, you can see, was also just coming off of a low level and starting to trend up and getting the same kind of follow through. So all these things were happening together at the same time. The bands on the upside are my acceleration bands in purple, and the longer term Bollinger Bands I like to look at in light blue. Interestingly, if you miss that first move up, and you're saying, okay, now what? Well, you see it's continuing to go up. Then we start to get a little bit of a settle down back into the acceleration band, and more importantly, the %R gives us a test back under that 80% level. I was doing one of my Friday trading room classes for my trading room students and basically saying, look, this is a great opportunity to create kind of the equivalent of a cover call, but with a lot less capital at risk. So what I did was we actually bought a 565 call when the stock was 582. That's $17 intrinsic, and it was trading at about 25. I said, you know, that's a little pricey. So, you know, and you can even see the option charts on some of these too. Remember, option charts, you can just type them in. We bought the June 565 call, and on that same bar, you can see there's where it was trading right there at about, finished at 27. It's about 24 at the low. We were talking about it when it's about 25 and a half. I said, okay, that's a little pricey. So, you know what? You can see it's done well since, right? But I said, I'm going to hedge that by selling a weekly option out a few weeks on Apple, the June 6th, 600 call, because the stock had some trouble up there right around 600. Well, you can see I sold that option for about $5. And you can see in retrospect, now it's up to like $12. But guess what? I netted about, it cost about $20.40, or basically $2,000, $2,040 plus your commission. And now that's up to over $3,100 or $3,100. And so you can see that, yes, I'm losing a little bit on the short-term option I sold because the stock rallied fairly quickly. But again, since we're benefiting from that out-of-the-money option being all-time, and frankly saying, look, yes, we're capped over 600 plus the $5 I collected on the 600 strike call. This is more of a strategy for choppy markets. Apple, instead of being choppy, Apple has raced ahead. Is there a point at which I would buy back that short 600 call before June 6th? Sure. If we get another %R pullback back to that 80% threshold, that's a spot at which I can say that should be support. That would almost be like buying another new position. The beauty of this strategy right here, folks, this retest strategy, is when you see it happening, people always ask me this question, and let me just give you the quick answer here. They say, how do you know that it's going to hold that low and not close under that low to violate your retest? And guess what my answer is? My answer is, I don't know with any perfect certainty that that won't be violated. Here's what I do know, looking at the history for Apple, and again, this is where you can look at the strategy performance report. And again, let me caveat that by saying this is past performance testing based on the %R breakouts and retests, and it doesn't guarantee any future trade, okay? So this is more of a guideline when you look at this performance graph. But you see that it gives us a sense that, especially since 2006, you know that Apple's really been on a tear in the last decade, right? Wasn't doing much on this system, you can see, back in the late 90s and most of the 2000s. Of course, not a lot of stocks were doing much through the 2000s, through the lost decade of Chop City for a lot of stocks. But Apple, of course, got going in the second half of this past decade and has continued on. Well, that's just showing you all the trades, long and short. It's actually even more telling when you look at the performance summary and you see that actually all the action in Apple has been to the long side. You know, you can see that the shorts have not worked. And yeah, you could do some other filtering and say, you know what, I'll only take shorts when we're below, say, the 200-day average. That helps, but it's still not as good as the long side based on my testing. So we are going to obviously have a lot more confidence taking long trades than short trades. So that should also remind you that you get a short signal, it's still above the 200-day, no thanks, and that one ends up being a quick stop out. You know, so you go back and look and you see some pretty nice little breakouts to the upside versus some fake outs on the downside. So that's where knowing what the system's biases are can help you. It doesn't, I always say, keep your amount that you allocate relatively small to any one trade. Even when you get on a really nice winner like this one on Apple, and we didn't even get it on for the trading workshop students until the retest. So, you know, it could even been even bigger right off of that breakout. We do those sessions every Friday, so unfortunately that was already breaking out midweek there. But bottom line is, you know, this is a beautiful way to get back on the horse. Now, how can we calculate what that retest level should be? Well, we know that this is still kind of a wide range because the high of the range was made today, just under 15 cents under 610. And if you count back from today back, you'd have to go back to early April, and you see that the low happened there just over a month ago, 511.33. So we've literally got almost a 100-point range. We're just like maybe a 99-point range, roughly speaking here. So you know that if it was a 100-point range, 20% off of 100 is 20 points, right? So the reality of this is you say, hold on, so that means the next retest isn't going to happen until you lose 20 points almost off of this high, take you down in the neighborhood of about 590. That is correct. You can see that, that's still, would have a ways to go, and at that point, we would buy back the 600 call and then try to maybe sell another option against it into the next bounce back to resistance. So, again, this is something where you have to say, okay, is that something you're willing to ride out? If you're not, you could always unwind the trade earlier. The max profit on this trade was only about, we put it on for just over $2,000, and the max profit was just under 1,500 before commissions. So the idea there is we're at about 1,100 to 1,500. You could start saying, well, you know what? I don't want to get greedy. I can always unwind this trade, go ahead and book the profits, leave the last few $100s for somebody else, and go looking for a new opportunity. If you have fresh ideas, that's a good strategy. If not, you can still be milking some time out of it over the next couple of weeks. So that's how we do Apple. Now, if you look at Apple, say on the hourly chart for you swing traders, you say, I don't want to wait around that long. Okay, so you say, well, you go back and you look. There's the move after the earnings, of course, very, very nice. That one never gave a retest until the trend was ending. So sometimes we say go ahead and on a fresh breakout, especially driven off of news, put on half of your normal exposure into a breakout and save half of your capital if you get a retest. That way, if you don't get a retest until it's violating, well, you don't feel too bad about hopping right back out and missing out on part of a move if you had bought the breakout. You can see on this one, it started to break out back here. Let's zoom that in a little more. Started to break out right here, and then it did follow through above that high the very next bar. So that was happening back on the 16th, 596.52, and then closing above there, 597.51. So if we're talking about options on the weekly basis, you'd have probably been looking at this week's expiration, the 23rd, last Friday, and saying, okay, if we were looking at the options, it was 595, I'd be probably thinking about a 590 strike call, something that's in the money reasonably enough. Remember, we're at 597.5. So what'd you have to pay for a 590 call back there? You said it's a 140523, C for call, 590 for the strike. The nice thing is it'll keep our cursor here, and you say, well, you'd have to pay 990. Now that's pretty attractive, right? Because you say, it's already $750 in the money and out of about $1,000. So that means that $990, we're basically only paying about 24% of the option as time, that remaining $2.40. And then that means that 75-76% of that option is intrinsic value. Obviously, from $990, it went up to $17 into this past Monday. If you're following that through, but obviously the option chart can be a little bit more volatile, so we tend to say, you know what, pay attention to not just where it says maybe to get out of the option chart on a %R violation, but really pay attention to the stock and say, you know what, if I'm looking at the stock, I know what my next retest was, is it came in just going back to Tuesday, a couple days ago on the 20th, right there on this retest. Now, this is an important point. That retest low is your new stop on a closing basis for whatever time frame you look at. If you're an hourly chart follower, that low is 602.42. If you place it intraday, you would get whipsawed and when it went down to 600 and change. But look what happens by the close of that next hour. It manages to hang in there ever so slightly above that key low, 602.42. It closed 602.73. Same thing happens the next hour. It's down to 601 and change and then pops back to 603. So the people that are putting stops intraday or intrabar there are getting flushed. The closing stop is what I call that. If it closes under that key retest low, then we're done with the trade. Pam says, do you set stop losses on the option trade? How in TradeStation? You can set a stop loss, most certainly, with an option. And usually speaking, we would tend to say, give it some room. Like when we start our straight buys in our weekly options accelerator, we'll typically say, let's go ahead and do about a 30% trailing stop on the option. So if you bought the option at, say, we said $10, we said you might $9.90, you might put the stop down there at like $6.90, down about 30% off of that level. So let's just look at that for a second and see if that was ever tagged. So it was a 590 call. Got that initial burst, and then you see it comes back down to about 1165 at the low. So if you were just buying in here off of this low right here at 1325, how far down did it go intra-bar? It went to 1165. So, and again, people say, well, that's too much to pay for an option. You're controlling a stock that's trading for over $600 a share. That's 60 grand that you would have to pay to control 100 shares. With one option contract, you control that 60 grand of stock for $1,300, right? $1,350. So, that's like 2% or just over 2% of the stock's cost. Put it in perspective, folks, and say that's pretty attractive. Now, if you used an initial trailing 30% stop on, say, 13.5, then you'd be saying, well, that's roughly speaking in the neighborhood of about $4. That would take you down to about 9. So you might have a trailing stop at 9 to start off. And then as it starts to move in your favor, you might say, okay, now that it's gone up here to, if you ever get a chance to, of course, double an option, you should take the double on half and run. Now, instead, you see it got to almost 20, it got up about 50%, then came down late on the hourly chart and getting close to the retest for the hourly chart followers when you go and look at the stock or the option. So, from this perspective, now let's talk for a minute about radar screen. Say, well, that's the past. What about now? Radar screen's great because, we can take any tool like %R. We can say, you know what? Show me what's really strong into the close here today. So green means that we actually got a breakout confirmed on a few stocks here. Wells Fargo, WFC in the number 2 position. Yandex is in the number 1 spot, but it's already been broken out for a couple days. So the Russian search engine stock. Verizon surprisingly breaking out late. Even Nike here breaking out late. So that move up and over there tells us, okay, we might have something there. Humana is one we were looking at, HUM. So there's a lot of little names popping up here. CVS, pharmacy chain. So these are popping up. Even the Q's giving a fresh new buy signal there. Okay, so that's on the bull side, and there's Netflix, which has had a big run here recently. Didn't do much today. Then on the bear side, we can flip it around. This is for you hourly chart this is daily chart followers. So that's the interval. We'll change that in a second to the intraday charts. If we're looking for bearish, bigger picture trends, we'd say, okay, well, we've got a few here. Walmart, I think Pam mentioned earlier, has been bearish. We actually do have a bear position on Walmart for disclosure because of that. Agrium was breaking down. Also, that's the inverse, the S&P. So, if you're getting a bear signal there, it's like getting a bull signal on the S&P, and we are on a bull mode for the S&P. These red ones signal a possible retest point when it crosses over that 20% threshold. So now let's change it for a second. We'll look at all the time frames here. So this is what all the work that my team and I do throughout each trading day. So we're trying to line up when you've got a buy on the daily, a buy on the hourly, a buy on the 15-minute. That can be powerful. So we're saying, look, on a %R bull scan, you see we already have a lot that have been staying above there. Only Teva gave us a new buy in the last hour. Most of these were already well above there, right? So that tells you you've been in a pretty strong market. We've got a little over 100 names here, and more than half of them are overbought. FedEx just went overbought late in the day. Bearish, anything bearish besides some of the inverse ETFs. You'll see Yoku, Sina, S-I-N-A. So some of those have been already bearish. Agrium, we just mentioned, and Newmont Mining, NEM, as well as Freeport, McMoran, Copper, and Gold, FCX. And then we even do the same thing on the 15-minute. So we're really kind of just trying to get all these triple time frames lined up. The more traders you can get lined up in your favor, the better. So you see Sina, probably the weakest stock on the board today of the big name stocks that I follow. But Cirrus, another one that was breaking down late in green there on the 15-minute. Also CHK, Chesapeake. So, we can then take that information. We can say, okay, so let's go in and let's plot a few of those different stocks. On the downside, we mentioned Sina was getting pounded, right? Well, again, look at the daily chart and you say, you know what? This thing's been bearish since it broke down back here. And even on that little retest right there on March 17th, it held that resistance. Look at what it did right there as well. Ran into that resistance, tried to trade above it, but flipped back down by the close. still bearish, and then another retest that came in here on April 17th. So that signal, believe it or not, has been intact for %R going all the way back to the last sell at $70.85, and now the stock's at $43. So it makes you feel like you're in it kind of late, but that's why we would look for retest points on whatever time frame you like to trade. This is a fairly fresh signal here on your hourly chart breakdown today, and then of course your 15-minute chart breakdown broke earlier in the session as well. So, that's where you could then go and say, okay, well, traded 11 million shares. Do I have an opportunity to trade an option based on Sina or not? So you could go look at, say, the Sina. Sometimes like a stock like Sina might not trade enough in the weeklies, so we might even just look for starters at the monthly at the money option just to say, yeah, it is breaking out. You see, but the daily chart's not really that confirmed. It's just crossing that overbought threshold there, which can be a fake out. You've seen it's been a couple times where it's kind of stalled up there after that. But 15-minute chart, you could see that was really breaking out earlier today. It's set up over 245 at 249. That's just the June monthly options before you even work it back down to the weekly options. But this is a starting point for saying what's actually trending the way I would want it to. Remember, the put's going up, that means the stock's going down significantly. So these are symbols that I use. You can obviously plot your own there. And so, with the option symbol, you can, of course, click on the stops and limit orders. You can just do a view order bar and pop that up and go type in if you wanted to buy that option. Of course, you could just type it in over here and go from there, okay? So, whatever time frame you want to do, you can certainly do that. Now, from this perspective, I want to look at both the bull and the bear side, like I was just talking about. So we were talking about a lot of different bulls that were showing up on the hourly chart. Like I mentioned, FedEx was just starting to signal. So you want to be a little bit careful if the stock's maybe late to the party, and say, okay, well, yeah, it's just starting to potentially break out here, it looks like, but it's already been on one of those breakouts from earlier in the day. But it really didn't make that much more upside progress today. But the 15-minute chart did give a nice little retest here. So I'd be kind of going in and scanning for that and saying, okay, well, yeah, CCI is not quite as confirmed as I would like it to be. When we broke out here, it never really followed through on the daily chart. So if I compare that actually to UPS, among those two transport companies, UPS looks quite a bit better on the daily chart. It broke out on %R. It broke out above these long-term Bollinger Bands. It's been holding right into those. And the CCI Commodity Channel Index also is a nice breakout there. So UPS is one that I've been watching. So okay, it's edging up on the hourly chart and had the slightest of violations on the 15-minute chart. So again, I'd probably be looking at like the June options for starters and then walking back down to the weekly like May 30th options these days. So the 100 strike call for starters, and you see that it's okay, but it's not super strong on CCI. It's good on %R on both of those time frames, but it's just not quite where I need it to be on some of the other supporting indicators. So literally what I'm doing is I'm flashing through trade after trade after trade. So one of the trades that I just got rid of today that we made a little bit of money on from yesterday into this morning was Twitter. So Twitter, speaking of triple time frames, the market's been up, and yet look at what Twitter's been on. It's still been on a sell. I've been bearish on Twitter for a while. You can see why. Steadily dropping ever since it broke the $50 level. Retest failure right there. Another retest, consolidated, and then broke down again. Retest, retest. Okay, so the retests have been good on Twitter on the daily chart for resistance. And then you factor in what's going on the hourly chart. So yesterday, we were coming in and saying, look, we're on an hourly sell. Got a little bounce happening here intraday. Got a little piece of a 33 strike put. But it was kind of volatile here today. So you can see when you look at the 15-minute chart from yesterday, it's kind of all over the place, and then it snapped down for us a little bit today. So I was in the Twitter, I'm out of it now, the 0523, expiring tomorrow now, the 33 strike puts. So when you look at that option, we were really liking how %R was breaking out on the 15-minute chart. You can see that thing was really rocking and rolling here. It had that nice CCI follow through as well. So we were buying it yesterday morning up to like $1.70. And you see, initially it was not doing a whole lot. Actually went against us briefly there. and then started to snap in our favor. So my first rule is sell part of it at 30%. Got out at $2.35, right into that little run right about here, 235. We move our stop up to break even at that point. At any trade under $1.70 is going to get us out. And you can see as it snapped back down under $1.70, we got filled and knocked out. Now, it's fortunate that we did because look at what had happened after that. It then went on to go all the way down to 90 cents and then back up to $1.50. We don't want that kind of a wild ride. We're not in for Mr. Toad's wild ride here. We are looking for a steady trending phase, catch it, and if we're wrong, get the heck out and move on to the next one. So, that's walking you through a lot of the principles that I like to look at here. Coming back to the charts here, you see a lot of what we're talking about here is looking for the rare trends, the trends that aren't supposed to be happening, the biggest trends that really the model says most of the time shouldn't exist. These are almost the more than 2 deviation moves outside of that, 2 deviation boundary. This is kind of what Bollinger Bands are classically based on, saying that most of the time the stock's going to trade from this range to that range, assuming it's starting off at this midpoint right here, the mean. So the point is that, okay, it should trade in this range here, but when it starts to get outside of that to the downside, watch out below, or if it starts to get up to the upside, even though it theoretically should only be happening a few % of the time, we find it happens more frequently than the markets really anticipate. So, with that in mind, we say, okay, factor in that you can catch some very nice runs here on this chart. And now, we're really focused on tools like acceleration bands and more. And then our focus list I was showing you before, we're looking for stocks that have shown us patterns that work over time. It doesn't mean that any one trade is going to be a winner. It just means that typically they're going to be stocks that are more growth stock oriented. Pam says, what link do we use? We're using 30 bars. So I'm giving you that as a starting point, so you can plug it in to get started and point it in the right direction. You can get all of our tools as part of a toolkit add-on for TradeStation, but we're looking at what is the most active type of names that are really going to be easy to trade in and out of. We don't really want to be trading stocks that trade their options by appointment. If it's you against a market maker, that's not a game we prefer to play. We'd prefer to play against a lot of other traders. So this focus list is something where we're really focused on the best of the best. And so a lot of the growth stocks, there's more than that on the optional stocks. There's something like probably 3,600 optional stocks, probably another 500 or 600 ETFs that are optionable, more indexes, hundreds of indexes that are optionable. So you've got way too many to focus on. So I like to break radar screen down into really my top of the top ones that really trade well. And usually it's growth stock oriented. As I said before, on management of capital, we tend to believe that you want to not over allocate your capital to any one trade. You're better off to keep your risk relatively small in any one trade and let your system play out across a large sample of trades. If you have an edge, that's just smart trading. If you don't have an edge, then you shouldn't be trading, right? So the point is that the difference between gambling and investing is having a probabilistic edge. If you sit down at the table in Vegas, you're gambling because the house has the edge, you don't. If you can create a system with a positive edge, then if you take it across a large enough sample size, then you truly are investing with a positive expected return. So the idea here is that we want to factor in how much time we have to buy. Usually we're looking about a week out. So right now we're kind of shifting to the May 30th expiration options for the bull trades. Occasionally for bear trades, we could be in and out, even in, like we said with Twitter yesterday, and then out today. So we were still trading the May 23rds. Knowing that we'd be in and out fairly quickly. Usually we're going to look for that in-the-money option strike when buying with a delta of around 70 to 80%. So that means we're getting a good bang for our buck already on the first point move. And then managing those stops, so we just keep tightening those stops over time. So I am at my hour plus here, but I do want to mention before I hand it back over to Mike that if you'd like to get invites to my future webinars that I do with my compliments from my Big Trends community, make sure to get signed up here through our free link, bigtrends.com/free. It also gives you a free ebook access and all kinds of other goodies getting started. So if you're not already getting that, You can talk to anybody that gets it, and they get a lot of great free information as a Big Trends insider. So make sure to go to that bigtrends.com/free link if you like today but would like to learn even more about it over time. You'll get periodic invites on when I'm doing a complimentary webinar for my Big Trends community as well. I want to thank Mike and all the good folks at TradeStation for having me today, and all of you for spending your hour with me. Let me hand it back over to Mike so he can wrap it up for you.
Thank you very much, Price. Really appreciate it. And everyone should definitely take advantage of Price's expertise and at least visit his website and sign up for his free webinars. Those are great. Thanks, everybody, for joining. We'll see you at another event. Good luck in your trading. Good night, everyone.